the economic monster, that Forex monster, the trading monster, the indexes, the commodities, the daily readings, the inflation in the country. What's it all about? How does it affect your trading? The trading has become one of the biggest things in the world that's affecting economies so bad that if one bank starts to go down, the entire country goes down with it. It's an absolute economic monster, trading is. Trading rules the world at the end of the day. So today we're going to talk about that. In the 30 years that I've been trading, I've seen markets crash. I've seen markets go up. I've seen markets go down. I've seen corrections. Man, I've seen a lot, and I've seen that the smallest things and the biggest things can have quite a big effect on the market. And I was asked the other day, do you trade the news? And we're going to talk about that as well. How do we trade the news? Should we trade the fundamentals in the news? But we will go to the charts as well. I'll show you the trading system, the price action system that I use that makes me a profitable trader. And after which, we'll go and we'll talk about the psychology of trading and how you can be successful in the stock market, trading Forex, trading indexes, trading whatever you like, guys, whatever time frame you like as well. Look, we're swing traders. We trade on the longer time frames, maybe the 4 hour. But if you're trading on the 5 minutes, good luck to you, because trading is risky. 60 to 80% of traders lose money on normal swing trading, normal position trading. Would you believe on 5-minute trading, 99% of traders actually lose money? So you really do need to be concerned if you're trading on a 5-minute time frame and you don't have the psychology to cover it. Hey, for those of you who don't know me, I'm Rob, and for those of you who do know me and you've watched my videos before, welcome back to the channel, and I'm glad to see you watching another video with me here today. So what is inflation? What's CPI? What's it all about? Now, the interesting thing is the economy is a lot to do with the flow of the money flow. In other words, the interest income and the taxes and that sort of thing. Does a country really need a tax system? No, not actually. They actually don't, because it's all about what the value of the country is based against its currency, based against its money. And the dollar is floating these days. It's not even pegged to the gold like it used to be. So the gold standard has been taken away. So effectively, your dollar is basically floating in the air and based on kind of the value of the country as such at the end of the day. Now, how does this all tie in to the economic monster? Well, if money flows into the system and people use it, then the country's going well. They pay for things to run. They pay the army. They pay for missiles. They pay for whatever. And then that empties out a little bit, and then they make some more money and they print it in. What they do with the tax system is they just put too much money in and take some back to pay for all those things. So at the end of the day, do you really need a tax system? Probably not. Most likely not. But the big problem with following the news and following inflation and following news items is you can look at when we had the last crash, the big crash of 2008, they introduced quantitative easing. So interest rates, what they're doing is they're just introducing money into the market. So in other words, you could take a loan at a negative interest rate. They would pay you to borrow money at the end of the day, which was insane if you think about it. And they added money into the market so that there could be more spending in the economy, because the basic principle at the end of the day is to keep all the companies in the country alive. You've heard the term too big to fail. They don't want large companies failing, because a large company failing is going to detract from the economy. It's going to drag the country down. And a large bank failing could be something as similar to a war, because what happens when a large bank fails or a large financial institution fails is everybody's invested in it. There's so many people invested in it, and there's people with homes with bonds and loans and so on, and it's just this effect that trickles down, because I don't know if you know, a bank doesn't hold the money. A bank is a bunch of shareholders, and the bank just takes money from the Reserve Bank, and it's kind of a middleman which serves you. So at the end of the day, if that collapses, then all the people that are invested in it collapse with it, and that's why they try and hold it up. You can imagine if something like Bitcoin was to collapse as well, how many people are invested in that. Huge companies are invested in that. There's so many millions of people that have got investments in something like the crypto. So now it becomes too big to fail. You need to hold it up to prevent the country from actually crashing down with it. Now, I used to hang my hat on the news, and I used to wait for these CPI data figures, and I used to wait for these, we're going to cut the interest rates, or we're going to put the interest rates up, or so many jobs were supplied this year, so that's the effect of how our economy is running this year, etc., etc. And I used to wait for these small news articles every single week, the fundamentals of trading. And what I found over the years was I'm wasting my time, because very seldom do they have any large super effect on your trading. Really, at the end of the day, all it does is it gets this knee-jerk reaction. It goes up, it goes down, it goes up, and somebody says something, and somebody starts talking about whether they're going to bring interest rates down next week or not, and they cut the interest rate, and everybody's excited, and the market goes up, and a few minutes later or a few hours later, it just sort of comes back to where it's supposed to be in the first place. Because at the end of the day, all of the companies that are invested in those indexes, all of the Forexes that are out there that are available, are pegged against an asset value, except crypto, of course. I don't know what that's pegged against, but those are just buyers and sellers trading against each other, so that can go either way. That's probably why it's so volatile in comparison to normal Forex, normal gold, normal indexes, because any normal share, for example, has a share value. Now, just trying to simplify it. So I'm going to take it away from indexes. I'm going to take it away from currency and Forex and commodities. And I'm going to say, let's say it's a company. Let's say it's a company like McDonald's, for example. I'm just going to use them as an example. So I'm not promoting them or anything like that. Just saying, now here's a company, and it's called McDonald's, and it has a value. It has an asset value. It has a number of stores. They say they're a property company, not a hamburger company. I don't know. But at the end of the day, what you're looking at is a situation is they have employees, they have salaries to pay, they have a company with a structure, they have assets and liabilities. Now you can go and look at those assets and liabilities, and you can really determine what this company might actually be worth. And they have something called a price to earnings ratio, where you can literally go and look at the forward earnings of this country and think to yourself, what's the earnings yield? What's this company going to bring me at the end of the day? Because in all probability, every single investment that you take, taking it with a view to hopefully making a profit in the near future. Or the far future, it doesn't matter. You're looking for a profit at the end of the day. That's all you're looking for, nothing else. If you take that and you extend that up into indexes, then all of those companies are part of those indexes. So the indexes hold those values. So they're based on an asset value. They're based on something that's holding them up. And if something was to crash that was holding that up, all the shareholders were to go bankrupt that were holding these companies up, you get this domino effect, which brings everything down. Currency, similar story. It's based on the asset value of the entire country. So the US dollar pegged against the euro is betting on the strength of America than against the strength of Europe, for example. And that's how the currencies peg themselves, based on that value. So it's an economic monster that you're actually trading, that you're actually involved in. And it can change on the flip of a penny, on the smallest thing. And you have to be aware of this. So many people get into trading with a view that they're going to be trading some squiggly lines, that they're going to be trading against some algorithm or some robot that doesn't exist. It is out there. There is an algorithm obviously controlling these platforms so they move up and down, and it's counting all the sells and it's counting all the buys and it's putting it through the system. But it's not trying to take your money. Who's trying to take your money is the other traders, the pro traders, the big guys out there are looking for liquidity, because if I want to buy something and nobody's selling anything, then there's no liquidity, so I can't buy it, obviously. It's like going to a shop and you want to buy apples, but there's no apples. You can't buy them. But if somebody puts apples there and says, I'm selling these apples, there's liquidity, there's something to buy. So it's the same in the market. If somebody's selling some stock, then it's there for you to buy. It's liquidity. So that's what you're looking for. You're looking for that liquidity. But you don't want to just pay any price for it. If you go to the market and you want to buy apples, and apples normally cost $10, you don't want to pay $100 for them, because that would be silly. You're going to go home and your family's going to laugh at you. How could you pay $100 for apples? What's wrong with you? Are you nuts? Exactly. So in the stock market, similar thing. You don't want to pay $100 if it's $10. So it's all relative. You're looking for a good deal. So when you're looking for that liquidity, you're looking for liquidity that's a good deal. Not liquidity that's a bad deal, because that's just not going to do anything for you. Because as I said, any trade that you take, any investment that you make, you're looking for that high probability in the future, that high probability trade in the future that's going to make you money. Guys, if you want a little trading book, it's free. It's in the description. I got it there for you. Go and grab it. I'm going to take you to the charts now. I'm going to show you how to trade a little bit of price action. And then I'm going to talk to you about the psychology of trading and a trading approach, the approach to trading. Because so many people think they're trading a system when you're actually not trading a system. That's just squiggly lines. That's just your high probability trade. What you need to do, guys, is work out how you can approach your trading so that you can be profitable. So it's a little business plan. It's a little thought on how can I make money in the market? And a win rate is definitely not it, because everybody who knows me knows that I'm totally against win rates. As far as I'm concerned, a win rate is a load of old rubbish. Anyone can have a win rate, but can you be profitable in the market? That's the difference, and that's what we're going to talk about after we've been to the charts. Let's go and have a look at the charts. And let's go and talk about the psychology of trading straight after that. The power of the economic monster is absolutely amazing. But now I'm just going to show you how to trade the charts. At the end of the day, what I find is trading the news can be quite daunting, quite complicated. And for those of you that only trade fundamentals, you must get confused quite a lot, to be quite honest with you. So I've backed off on the smaller fundamentals, the interest, the jobs figures, the CPI, that sort of thing. They don't concern me too much when I'm trading. What concerns me is the bigger things like bankruptcies and wars and things like that, geopolitics. That's you can keep an eye on because that changes things in the world. But trade what you see. That is so important. Trade what you see. The trading world is massive. It is a monster. It's one of the biggest things ever. And it really does control the world. Without trading, most of the economy wouldn't survive the way it does as it is at the moment. Everybody's invested in everything. If people are invested in a bank, then that's the owners. Everybody's invested in that and they're keeping it afloat and so on and so on. So trade what you see. Now, for example, you look at this US dollar, Canadian dollar trade. What you're looking for is a support area, and what we found here on the 4 hour, because we're trading on the 4 hour, is a demand area, an area where there's some money lying, an area where you can now take a long trade. See, it was long, came back. Now it's taking some money here and it'll go long again. So look for supply and demand, look for support and resistance. But then how do you find support and resistance on any given trade? Especially on a trade that's moved like this one. I mean, if I take the drawings away and then I look at the US dollar CAD, look at that straight up in structure, straight up. Now, the nice thing about the US dollar CAD is it's trading in trend. So you can trade with the trend and rather than against the trend. If you want to trade counter trend, then you must wait for it to break the structure. Because there's 3 ways that we trade. We trade in the trend, we trade in a range. This is a range, you see it's in a range, and we counter trade. So counter trading would be if we were to go short against this trend. But what we do when we counter trade is we wait for it to break the trend, break a support line, break a low, and then we can take counter trends against the overall trend because it has now broken the trend. Now, what the best trade is to trade with the trend. Now, if you take this US dollar, Canadian dollar, I would take anything here, but the US dollar, Canadian dollar might be a reasonable example. I don't even know. Let's go and take a look. Let's go to the day chart. I'm going to move it onto the day chart. There's your day chart on the US dollar, Canadian dollar. Now, what I'll do is I'll take it to a line chart. And the reason I do that is on the candles, you've got your sort of highs and lows on these tails. And that's not what we're looking for. What we're looking for is the closing prices, because the closing prices give us a much better idea of where things are. Now, at the moment, is there another high? No, it looks like it's kind of hit an all-time high. So what we're going to do is we're going to look at this area that used to be a resistance as a support now, as an area that would now be known as a support area. So it'll come back into that area to retest. And it is now a support area because it has hit here once and supported. But here it was resistance. It broke through the resistance and it has now become a support. But what we don't have on this one, because this would be a resistance if you were below it, and this would be your support down here. You see down here where it's an area that the price keeps getting to. That's an area where the price keeps getting to. It's like a magnet, and then it pulls back. And that was now resistance. Now it's broken through the resistance. It's become support. It's come back, retested it, and it's gone up. So now this is now support, and there's no other highs to give you an absolute high. So that gives you a little bit of a dilemma on a trade like this one. How do you now work out where the resistance is? Well, it's not too difficult at the end of the day, because what you can do, you should have 3 points, but it really doesn't matter. You've got a bit of a trend here that I can see running through here, okay? And at the bottom, you've got a bit of a trend here running through the bottom here. So you've got a bit of a situation where this could now become an area of where it's running in this area. It's running in this trend. It's running between these two lines, let's say, okay? So this now becomes a trend resistance. This now becomes a trend support. Because you don't have an all-time high to draw it across straight. The reason I draw a block is because the market doesn't see lines. It's an area where there's some money, where buyers and sellers are putting their orders, because the whole point of trading is you're looking for some liquidity in the market. That's what it's all about. You're not looking for a line. Lines don't do anything. Okay, so now this has broken through that resistance, turned it into a support. It's now hit a trend resistance and it's come back. Perfect. Now what we do, take it back to the candles. Now what the candles do is I leave them red and green, because the green ones tell me it's going up and the red ones tell me it's going down. Really simple, really, because I trade both ways. It doesn't really matter to me. And if I see a green candle come up from a support, that's a buy. If I see a red candle come off a resistance, that's a sell. Simple as it gets. Green bar there, buy. Okay. Now let's go back to the 4-hour chart, because that's what we're trading on, and look for other levels that can work for us. Now what we've got on our 4-hour chart is a really nice picture where you can clearly see it's gone out, it's gone through the resistance, it's turned it in support, big green candle, gone up, come back, retested this to see if it could break back through, didn't, went all the way up, it's gone into this area, and this would be an area as well of trend resistance, broken through it, come back, and it's going down again. But on your 4-hour, what you've got is what I had drawn in previously. There's a very nice demand area. If you watch my videos on supply and demand, you'll know how to pick them off. Normally, I would look for 3 green bars to create a demand area or a supply area, but that is such a strong green bar that I have to count it as an area where there'll be some liquidity lying, where there'll be some money lying. And then if it breaks through here, it'll just go to the support, but otherwise it'll turn around with a nice green bar and continue on to the upside. Then you'll be looking for this to go up and either bounce off this trend resistance or go through and carry on to the upside, because this is bullish, it's trend. You don't want to short this, you want to go long. And if you look on the 4-hour, you've got an internal trend support. An internal trend support on the 4-hour. I don't want to draw too many lines on here. I don't want to confuse you. You don't have to wait for the stars to align on the left and the moon to turn to green cheese before you can take a trade. I'm just showing you how we work with price action. All the charts is a high probability trade. That's all it is. It's just the probability that you're going to make profit in the future. That's what the charts are. The charts are no guarantee. The charts are not about the money. How you make the money is what I'm going to tell you right now after I close this chart. So go and listen to what I've got to say. That's how you're going to become profitable in the stock market. You've been to the charts. Now you know what the high probability system will do for you. It's just a system that you can use to take yourself to the next level, high probability trading system. But at the end of the day, what you want is to be profitable. You want to make money. Now, why I say a win rate is worthless is because if you're scalping, for example, if you're taking quick wins, so now you take 10 trades, you win 9 trades out of 10, but you win them all by going in, getting out, going in, getting out quickly, going in, getting out quickly. You're not holding any of your trades. So you're not holding your trades to a profit target. You're just getting in, goes into profit, you're getting out. And then you're going to take that one trade that's going to go into a loss. We all know that trade because I know that as a scalper, your psychology is not going to let you get out of that trade, because as a scalper, your thing is to get in and quickly take a profit. And if you go into a loss, you're going to hold it until you get into a profit, because I know your psychology. I know how you think. And that's going to go farther and farther and farther into the loss. And I know what you're going to do next. You're probably going to dollar cost average it, because that's what you all do. You're going to dollar cost average it because you're going to think, I'm going to dollar cost average it, and then it's going to come back and I'm going to make a scalp, a quick profit again. But you know what? It doesn't come back. It just keeps on going, goes to the pits. And you know, everyone has their limits, and you just decide, oh, I'm taking far too much loss on this, let me get out of it. And you take the loss eventually, because you can't take any more loss. You just sort of like, okay, that's enough for me. But the loss was a couple of $1,000, and your 9 wins was only like $100. So win rate, you've got a 9 to 90% win rate, but you've just lost most of your money. So how does that work? Doesn't, does it? As far as I can see, that doesn't work. So here's a plan for you guys. You can use it, don't use it. Totally up to you. This is what I do. This is my plan. This is what works for me. Very simple. You don't have to write it down. All you have to do is remember it. And that is, for every single trade that you take, risk 1% of the account. So if you have a $100,000 account, risk $1,000 on each and every single trade. That's it. Don't change the stop loss on every single trade. Keep it the same. Don't make it less, don't make it more. Exactly the same. The reason I tell you this is because the markets are 50-50. And don't tell me it's not, because the market's made up of buyers, made up of sellers. Got nothing to do with squiggly lines. Market's 50-50. No matter what system you've got, no matter what win rate you think you've got, the market's 50-50. Because when you drill it down and you actually take a trade where you actually go and try and make the actual profit instead of getting out too early, then your win rate will suddenly change. It won't be 90%. It'll be 50-50 if you're lucky. Then you keep the stop loss the same. Are you in the trade? Part 2 of the business plan is, if your trade goes into profit and it goes like 30, 40, 50% into profit, let's say it goes $600 into profit, move your stop loss up to break even. And if it makes you feel more comfortable, slightly in profit. Now your trade is completely free. When you took the trade in the first place, you had written off $1,000 with a possibility of it losing. But now it's winning. Now you can take it up to break even, and it's costing you nothing. If it comes back and takes that stop loss out, don't look at it as, oh, I've lost money. No, you haven't won anything yet. You just haven't lost anything either. That's all. What you're trying to do is gain a big win. I know most of your psychologies. Most of you will go $300 into profit and click out and get out of the trade because you want to take that profit. You don't want to sit in there and hopefully it gets to $2,000, because that's what you want. You want to make more on your wins and lose less on your losses. I mean, you can't have a stop loss of $1,000 and a target price of $500. That's just stupid, because that's half of what your loss would be. You want to make more on your wins, not less. So you're looking at a trade that's going to give you at least $1,500 to $2,000 or more. Now when it goes up past the $1,000 and it goes past the $1,000, $200, $300 in profit, and you're going, I'm so happy, I just want to get out of this trade. Don't get out of the trade. You're holding the trade because your target's $2,000. Now what you do is you move the stop loss further up, maybe to $1,000. That way, if it comes back, you've actually made $1,000 profit. That's not bad. It's a 1-to-1. It's not bad. Now your entire portfolio is on a break even. And then it goes up all the way to the $2,000 that you want. Take the stop loss right up behind it to the $1,900. If it comes back and takes it out, guess what? You made target. Amazing stuff. Easy. Now, if all 10 of your trades lose, which is unusual, but if all 10 of your trades were to lose, and they were to lose in a row, which should never happen, but it does, you would lose 10% of your account in total, which is quite easily recoverable. You haven't put all your eggs in one basket. You haven't tried to overtrade one trade. Over a period of 10 trades, you're risking 10% of your account. And 9 times out of 10, you'll win half those trades. And if you're looking for bigger profits than you are losses, you should do well. You'll have a whole mishmash of small losses and wins, because some of those stop losses that you moved up will get taken out at a smaller win. They'll still be wins, but smaller wins. And that will give you a great win rate, and you'll think you're a genius because you've got this amazing win rate. But at the end of the day, it's all about making a profit. That's what it's all about. Guys, thanks for watching the video. Come back and watch the live show tomorrow, and watch the last videos if you want to know a little bit more about the trading systems. And don't forget, trading the economic monster can be quite tricky. Should we trade the news? Shouldn't we trade the news? I prefer to only trade the bigger news and leave the smaller parts out. I'll, you know, the CPIs and the inflations and things like that happen during the week, I'll get to those. The bigger ones are the ones I keep my eyes on. The bigger moves, the crashes, the banks going down, the wars, that sort of stuff. That's what I watch. Guys, thanks for watching the video. Don't forget to watch the last video. Till the next one, cheers, thanks, and bye.